This is going to be the second biggest home decline since the Depression. I don't know, but I keep on hearing that we're in for a crash. Wait until 2023, 2024. And a lot of people are super bearish. And now we're seeing Wall Street jump into this and saying, hey, this is going to be bigger than we thought. It all comes down to one thing, though, which I'll jump into. But it comes down to where the interest rates are right now. And they're in the sevens. I mean, we kind of saw where they were heading, right? If they stay in the sevens, then we may be in for a treat. If they continue to decline more and go the other way, then we'll probably see a lot less damage. Look, let's jump into this article because I think it's well written and well rounded. So I always look for these to share with you because I like to base everything that we talk about with facts. And facts are still arbitrary in some cases. So take a look at this, but also pay attention to the details because they also say, and I'll note it, they also say, hey, we really don't know what's going to happen. It's an affordability issue right now, but we don't know which route this is going to take. So pay attention to that. Well, look, facts are facts, but at the same time, it really depends who's reporting it because there's a lot of bias behind certain facts. And are we reading all the facts, right? So that becomes a challenge. But look, take a look at the headline there. While I take a sip of my coffee here. Wall Street, U.S. housing market to see the second biggest home price decline since the Great Depression. That's a woozy. So here we go, a doozy, sorry. Here goes. That history or lack of history is why recent outlooks published by the Wall Street Titans are raising eyebrows. Not only is there a building consensus on Wall Street that we've entered into a period of falling home prices, yeah, we've seen that, but there's also a consensus it will be the second sharpest home price decline since the Great Depression. And so here's where we're going to go into it. They break down three of these Wall Street companies and show you what they're predicting is going to happen. So pay attention to the details though. Here, number one, Morgan Stanley, U.S. home prices to fall 7%. Okay, interesting, right? It's a really good point on that. Haha, my dad always said, figures don't lie, but liars figure. So funny. Last week, Morgan Stanley finally joined the housing bear crowd. Heading forward, the investment bank now expects U.S. home prices to fall 7% by the end of 2023. Now, when we look at this as a whole and we try to understand, well, what does a crash look like? Typically, a crash looks like 20%, right? And we're at 7 next year. So this is why they're calling it a price correction, right? And now, obviously, they don't know, is it going to go deeper? Is it not going to be as bad as they're saying? In some cases, the thing is nobody knows because interest rates, it's all an affordability issue right now. Now let's scroll down to the section that I thought was great here. Keep in mind that 7% decline in Morgan Stanley's base case forecast. The investment bank has also issued a bull case and a bear case. If mortgage rates come back down to earth by next spring, right, U.S. home prices could climb 5% in 2023. But then again, even though they may climb, does that beat inflation, right? In that case, we didn't even talk about that. But they're saying, hey, look, if interest rates do come down, and they may, then where are we? And they're saying, well, it looks a lot better in that case. Conversely, if the country slips into a recession, and some people are saying we're already in a recession, I don't know. Let's just say we're not, just for the case of this article. If we go into a recession, Morgan Stanley then says the national home price decline could exceed 10%. Notice that it didn't say it would exceed 20%, making it a crash, right? Technically. So now let's go a little deeper. Goldman Sachs, U.S. home prices to fall 5 to 10%, which is interesting because we just went through this and the median was 7.5. So why don't they just say 7.5? As weakening housing data trickled in this summer, Goldman Sachs affirmed its positive home price outlook for 2023. Well, that was until it caved last week. Yeah, they decided to turn around and say, wait a second. And they said peak to true. And then, you know what? we actually read this last week. It says Goldman Sachs now expects U.S. home prices to fall 5% to 10%. That's a sharp downward revision from last month when the investment bank predicted the U.S. home prices would rise 1.8% in 2023. That goes down to affordability. It goes down to interest rates. Here's what's going to happen if interest rates do come down into the fives again sometime this year. This will all start turning around and people will start predicting, oh, you know what, we won't be as bad as we thought. Again, this is a day-to-day thing, week-to-week thing, and interest rates really determine the affordability. This is why you see a lot of these companies go up and down. Now, pay attention to what Moody says, because this one we've been following since March. Moody's analytics U.S. home prices to fall 5 to 10%, same as Goldman Sachs. Good mortgage underwriting. Here's the reason. Pay attention to this because this is what we've been saying in the real estate world. This is the reason we're not going into a crash. It says good mortgage underwriting, plain vanilla lending, record low vacancy rates. That's why Moody's chief economist Mark Zandi says we aren't heading for a 2008 style housing crash. Very smart. However, Zandi says improved lending practices and tight housing supply, which is the case now, won't be enough to prevent an ongoing home price correction, but it will prevent a crash, right? I mean, we can infer that from that sentence. The fundamentals, he says, are simply too detached from reality. Now, here it is again. Moody's Analytics expects, this is why I highlighted it in blue for you. Moody's Analytics expects U.S. home prices to fall 5% to 10%, even if a recession doesn't come to pass. Again, they're saying we're not in a recession. Ben, I agree with you. I don't think they're lowering the rates on that. But one thing that, here, I'll stop sharing really quick just to talk about that. Although the Fed will not lower the rate, I agree with you. What happens is if we start getting into more of a recession, a lot of the investors start investing in the bond market, and part of the bond market is a 10-year treasury bond. And if we get a lot of people investing in that, in some cases, in most cases, what we've seen is interest rates for mortgages typically go down. So that's what they're indicating, right? So great point, though, Ben. I like that. Now, it says, even if a recession doesn't come to pass, if the country slips into an economic downturn, Moody's Analytics predicts U.S. home prices would fall by 10 to 15%. And that's because then we start taking into case unemployment and other things that may happen because of unemployment, right? Consumer confidence and so forth. Now, either way, Zandi says it will likely take 12 to 18 months for prices to bottom out. And so that's why you see a lot of these companies that are saying, hey, we're heading into a recession possibly. Prices are going to continue to come down. So in 2023, and that's why they're saying, hey, in 2023 is where we're going to get hit, possibly. So wanted to show you that now. This map shows you what Moody's Analytics says are the housing markets that are overpriced. If we take a look at, I'm going to show you here, zoom in. If we take a look at this blue color, that's just showing that it's lower chances of being overpriced. Light purple, obviously getting a little higher, and black, totally overpriced according to their stats, right? And some people say they're a little skewed and not 100% correct. I would agree, but it gives you a good indication. If we zoom in to the area that's the most overpriced in the United States, according to this map, and that's according to Moody's, it would be, where is it? Here it is. It is Boise City, Idaho, 76.9%. And then you go to the second highest one, I believe, is going to be Flagstaff or Austin. You got 65.58 in Flagstaff. And where's Austin, Texas? Up here. Austin is 61.1. So those are the three highest ones. And then I'll put up the link to this one so you can fool around with it. Take a look at it. Obviously, this is not 100%, right? But it gives you a good indication as to what they think is going to happen. You can take a look at what they think Florida is like. It's mostly overvalued by a lot, right? It's all black. And you take a look at the areas that are purple. They're overvalued, but not significantly. Here's California, where I'm at. I'll zoom in for you. There's a few areas that are not overvalued according to what they're saying. It's only about 10%, which is not bad. And then the middle areas right here, and then the darker areas, you got Riverside being overpriced in Santa Barbara County. At the end of the day, we don't know, and this continues to change because it all comes down to affordability, interest rates. Those are the main things right now. Now, as we end this, there's a couple of things. When a group like Moody's Analytics or Goldman Sachs says the U.S. housing market or U.S. home prices, they're talking about an aggregated view of the country. And that's what I've been telling you. It differs in different areas, right? It's on a regional level, those results are going to vary. There are some areas that are not going to be hit at all. And there are some areas right now that are doing well. So pay attention to your region as well. Now, let's go down here. Fitch Ratings, U.S. home prices could fall 10 to 15%. And I'll put up the link to Fitch Ratings as well. Here it is. Let me see if I can zoom in for you. Fitch Ratings. You can see here total housing starts. So those are all the new homes that are being built. You can see the predictions up to 2024. Single family starts, red, and new home sales are significantly down from where we were. And they're going to continue to stay a little flat or drop in the coming months. If you go down to the U.S. economic indicators, which are the most important here, the GDP growth, they're saying, it came down through 2020, dropped down with unemployment as well, right? Unemployment's the red one, blue's the GDP growth. And so very little, in fact, unemployment's not doing too bad here. But if any of those go down even more, again, that becomes a bigger issue. So I'll put up the link to that one as well. And here I'll end it with these two. It says the likelihood of a severe downturn in U.S. housing has increased. However, our rating, this is Fitch Ratings, our rating case scenario provides for a more moderate pullback. All right, so let me zoom out here so you can read it with me. A moderate pullback. That includes a mid-single-digit decline in housing activity in 2023 and further pressure in 2024. So if you think about that, again, far, far away from the crash of a 20%. So this is why they're calling it a correction, right? And we go down here, we'll end it, and then this is what they say, which is interesting. This is Fortune magazine. Of course, if home prices actually drop 10 to 15%, Fortune might rebrand the pandemic housing boom to the pandemic housing bubble, right? Sounds more fitting. And then that goes with the whole theme, which is nobody knows what the hell is happening. And that's why a lot of people quote Socrates when he says, you know what I don't know. In this case, I don't know anything. We're just kind of living day by day. All we know is that it's an affordability issue. And then the Fed has no clue what they're doing. And they keep on increasing the rate to get control over inflation. We just have to take this day by day and see where are we heading, because the more information we have day to day, the better decisions we can make. And right now, interest rates are at 7. Are they going to come down? It sure looks like it. But then again, I don't know. Just pay attention to the details. I'm bringing as many facts as I can. Well, okay. And Ben, you can answer this at the end. What platform are you putting the links to? Ben, thank you. I'm putting this one to YouTube. That's where I put them mostly, only because in the description section, it allows you to expand on it and go there. So Ben, thank you so much. And everybody else, any questions you have, feel free to dump them in here. And anything that you think I should be adding or something that I may have missed, I always love you adding that input as well. So thank you so much. Have an awesome day.